Welcome back to the Williams Real Estate channel. Today we are running through the property market update for Australia for October 2025. We saw a strong month from the Australian property market, up 1.1% across the board, with the combined regions up 1% and the combined capitals up 1.1%. For the month of October. The strongest region was regional WA, up 1.8%, followed by regional Queensland, up 1.1%, regional New South Wales, up 1%, South Australia, 0.9%, regional Victoria, 0.8%, and regional Tassie, up 0.6%. So pretty strong month for all the regional markets across the board. We then had an even stronger month out of the combined capitals, where we had Perth up 1.9% for the month, followed by Brisbane up 1.8%, then Darwin at 1.6%, Adelaide 1.4%, Melbourne up 0.9%, then Sydney at 0.7%, Canberra 0.6%, and Hobart trailing at 0.3%. So pretty strong month. Every region, every capital in growth. If we now look at 12 months to date, the past 12 months, we will see the entire Australian market up 6.1% growth. The combined regions outperforming the combined capitals over the last 12 months. The combined regions up 7.5% and the combined capitals up 5.6%. The strongest region for the past 12 months has been regional WA, up 13.5%, followed by South Australia, up 10.5%. Then regional Queensland up 10.1%, with the trailing markets being regional New South Wales 5.2%, regional Victoria 4.5%, and regional Tassie up 4.1%. So above all, pretty strong last 12 months across the board, with the leading markets being regional WA, South Australia, and Queensland. When we come to the capitals, the leading market for the past 12 months has been Darwin, up 15.4%, followed by Brisbane, up 10.8%, then Perth at 9.4%, Adelaide 6.7%, and then trailing with Sydney up 4%, Melbourne up 3.3%, Canberra 3.2%, and Hobart 2.4%. So again, strong markets out of Darwin, Perth, Adelaide, and Brisbane. Adelaide looks to be losing some steam in the data, and the likes of Sydney, Melbourne look to have been starting to pick up in growth. Now, I also like looking at the index across the board to gauge where every metro market sits in terms of a medium value. In first place, Sydney, 1.25 million median price point. Sydney's always historically typically been the leading market, other than a couple of moments in history where Perth overtook it during the mining boom. Sydney's leading in first median price point, followed by Brisbane in second place at 992,000 median price point. Then we have Perth in third place, 844,000. Canberra in fourth place, 877,000. Followed by Adelaide at 867,000. Melbourne at sixth with 818,000. Hobart in seventh at 686,000, and finally Darwin in eighth place with 564,000 median price point. Now, if you wish to understand where we are heading into the future, as you would know if you've been following us for some time, we use the 18-year land cycle history as our framework. We then run historical sales data reports and overlay it with the framework to work out where each market is heading as a guide into the future. So we are on the blue marker, equivalent point of time, late 2006. We are entering the fourth and final quarter, where we see the likes of Darwin, regional South Australia, regional WA, regional Queensland outperform. So from here, if you can visualize from 2006 and onwards, in each of these long-term trends, you'll be able to visualize a guide of where they could be heading into the future. First off the bat is Adelaide. I've structured these from top down, from overheated markets to suppressed markets, or risk versus opportunity markets, however which way you like to see it. Most people like to plow into the overheated markets towards the tail end, but we don't like to do that. We like to get into the suppressed markets with the great opportunity upside, as you will be buying the future growth and not what has been historically when you acquire a property in a market. So to kick it off, Adelaide, as you can see, has been going pretty strong in the recent years. Since 2019, 2020 has taken off, is now hitting in this specific suburb for 50,000 median price point for units. And if we look back at history, there was a little bit more growth from 2006 and onwards, but then more or less hit a top and then went through a pretty well stagnant, flat, subdued growth path. So if you can visualize from here and onwards, looking pretty similar as a guide from 2006 and onwards, that is what could more or less happen in the future years ahead. History doesn't repeat exactly, but it rhymes, and this is the best guide I have found to work out which markets to buy into, when to stop buying into markets, when to add value, when to renovate, when to develop, even when to sell. So this is our framework we like to use. And you may be thinking, why are we looking at units and houses in the regions? The way I look at investing, I like buying individual units, villas, townhouses in metro markets, as well as blocks of units in metro markets, and then houses in the regions and blocks of units in the regions. I would rather buy a couple of individual units and a block of apartments versus a house in the metro, because by the time you buy a metro house, you are paying millions of dollars, and it just doesn't stack up from a return from a rental yield perspective. You typically have to pay a premium, and you don't get as good a return as you would on individual units or blocks of apartments. So we like typically focusing on individual units, villas, townhouses, and blocks in the metros rather than houses. We do like houses in more so the regions, as you can buy them at a lower price point with a stronger yield, and they do work from a perspective of building a portfolio. So we don't typically buy houses in metro markets, because by the time you spend $1 million plus, I'd rather go and buy a block of units for that price point. So that's a bit of an explainer of the charts we're running, and that's how I look at the data. I don't look at data on houses in metro markets, because I'm not buying houses in metro markets. Regional South Australia houses is going strong in recent years. Again, started its boom in 2019 to date. But if we look back at history, you'll find that the market is also potentially coming to a top and could well go through a stagnant, subdued, flat growth path in the future years ahead. So definitely not a market we're buying in 2025. Same goes for Perth. Booming, await the races. Every man and his dog wants a piece of it. As you can see, has really kicked off from 2020 to date and is going strong pretty aggressively. But if we look back at history and we see what happened from the equivalent point of time in the prior cycle from 2005-6 went strong and then switched off in early 2007 and then went up and down through this subdued up and down growth path to even to a lower price point in 2019 than of what was in 2006-7. So Perth units in 2025 is high risk. You'll probably land close to, or if not in negative equity at the current price levels in the future years ahead based off long-term trends. So definitely a market we are not looking to buy into in the next couple of years. Regional WA, this is about 2-3 hours south of Perth down near the Margaret River region. This is high risk. As you can see, await the races, hitting 750 median price point for a house. And if we look back at history from 2005-6, it also went strong and then switched off in 2006 and went backwards for over 10 years. So again, a market we're not suggesting to go and buy into, as at this stage, it's definitely got high risk for the downside. And those that continue to buy in that region will probably land themselves in negative equity with it in the next 5 to 10 years. So definitely a market we are not buying into. Brisbane, this is the Logan area in Brisbane. Await the races. We were buying a lot up in Logan from around 2018, 19 to 23. But as of 24 and onwards, we haven't been buying for the last 2 years. As you can see, it's await the races, solid growth. Hasn't shown signs of losing steam yet, but in the next one and a half, 2 years, I suspect it will start to top out and then lose steam and go through this subdued flat growth path. So at this stage, definitely not a market we're buying into, even though the mainstream herd continue to keep buying up and thinking it's the best market since sliced bread, and everyone keeps pouring in because of the Olympic Games and all the FOMO. It's quite ironic because when we were buying in 2018, 2019, everyone thought we were crazy. Why are you buying there? Brisbane hasn't gone anywhere in so long. We're buying at lower price points than what people paid in 2007-8. It's the same commentary we were hearing when we started buying in Melbourne 2-3 years ago. The market is starting to slowly turn down in Melbourne, and it's the same commentary we were hearing in Brisbane at the time than what we were hearing in Melbourne when we first started buying, to give you a hint. But this is Brisbane, await the races, has a couple of years left in the tank, but at this stage, we're definitely not buying. And personally, I'm even looking to potentially offload properties next year and the year after out of Brisbane, but even before the Olympic Games. Now we have regional Queensland. Await the races, and I think I need to do a little bit more deep dive to show everyone the risk of regional Queensland as of to date and moving forward, because I see a lot of people pushing people into these markets and they will end up losing their shirt. This is a similar growth pattern to most of the regions in Queensland. They're await the races. But even though they have strong yields, the yields can also go the other way as well when the market turns, because regional Queensland has a dependency on the mining sector. When the mines kick off and boom, and there's lots of high-paying jobs created, people have more money to spend on rent. those higher rents get capitalized in the higher price. That filters down to the benefit of land price, and we see a boom. But when the mines slow down and the jobs dry up and there's people that can't pay the high rents anymore, the rents can get cut in half, and so do the property prices. So yes, you may be able to still get 6-7% yields today in the current market, but that doesn't necessarily mean that it will be long-term sustained growth off the back of those current rental yields, because the rental yields can also get cut in half. Just like what happened from 2009-10 to 19, this town lost over 40% over a decade. So buyers beware. Most of the regions in Queensland have passed their point of no return at this stage, because if you look back at history, in 2006, which is where we sit in the equivalent market, there is a couple more years to run, but once the market does turn, it'll end up just like what happened in 2016, 17, 18, 19 at a lower price point than in 2006. So what does that mean? Potentially, if you buy in 25, 26 in regional Queensland, you could be exposed to being in negative equity in the future years ahead. So buyers beware. Darwin is starting to pick up again and run. And if you look back at history, Darwin had a solid boom from 2005, 6 all the way to 13 off the back of the mining sector. And it looks to be picking up again and could well potentially be going through that similar growth path. I'm not a super fan of Darwin. I'd rather deploy capital into other markets because, as you can see, this medium price point for this suburb is over 450. You can get lower price points in better markets that are more diversified, that don't go through this significant boom bust pattern. Hobart has had a solid run in recent years, topped out in 21, 22, went through its downturn, now showing signs of stabilizing. And if we look back at history from 2006 and onwards, we'll probably just, from this point moving forward, plateau out and stagnate for a good 10 years before going on its next growth path. So definitely time on Hobart, and same goes for regional Tassie. Pretty similar growth path, had a solid boom off the back of Melbourne. Typically what happens is the likes of Tassie will outperform off the back of Melbourne, and Melbourne's only just getting started. So there's plenty of time on Tassie. We do love Tassie. We'll get down to Tassie at some stage, but there's plenty of time. As you can see, this is boomed. This market topped out in 21, 22, went through its downturn, showing signs of stabilizing. And if we look back at history from 2006 and onwards, pretty well went flatline. So can expect regional Tasmania to flatline for another 8 to 10 years before picking up again and going through its next growth cycle. So sure, you can buy a cheap house today, but cheap today can mean cheap tomorrow. So there's no rush on Tasmania at this stage of the cycle. Same goes for regional New South Wales. Had a solid run off the back of Sydney from 2017 to 22. Since topped out, has gone through its downturn, now showing signs of stabilizing, and will probably stagnate from here onwards for a good 7 to 8 years before starting to pick up and run hard again. So again, regional New South Wales, there's plenty of time. Same goes for regional Victoria. Had a solid run off the back of Melbourne from around 2015-16 to 2021-22. Topped out, went through its downturn, showing signs of stabilizing, and will continue to stagnate for a good 3 or 4 years before picking up again. So I know people are buying up in regional Vic. I think they're getting out there a little bit early. There's definitely better opportunities that you can buy in to get growth in the near term than going and parking money in houses and building granny flats to justify the yield. That doesn't make sense. The rents rise first, creates attractive yields, prices then follow. It doesn't make sense buying a house with a yield of 3 or 4% and then building a granny flat to justify buying an overpriced asset in the first place. I like to buy when the yields are strong and allocate funds when they're ready to run. And regional Victoria definitely has time at this stage of the cycle. Sydney is starting to come good. We've been buying in Sydney for a couple of years now, and we'll continue to keep buying. As you can see, the boom is on the horizon. Sydney boomed from 2008, 9 to 2016, 2017. So people ask me, why are we buying now if we're due for a downturn? Well, this is why we are buying now, because we want to get ahead of the curve, ahead of the mainstream. When the market turned in 2008, Sydney, Melbourne took off. As you can see, this chart, this suburb went from 250 median price point, boom, to over 500. So it doubled. And ever since, it's been up and down within the range of 450, 500, starting to pick up again slowly. And I suspect within the next 2 to 3 years, Sydney will start to become a leading market again for the next growth cycle once the demand shifts back from Brisbane, Perth, Adelaide, and their respective regions. Once the mainstream herd realizes it's no longer a good idea to keep buying in those markets, that's when Sydney and Melbourne will take off when the demand shifts in the coming years. Melbourne's already started. It's already running. Yields in Melbourne a couple of years ago were 3-4% after the prior boom that ended in 2017, 2018. And Melbourne did have a bit of a tough time through the lockdowns, COVID recession. It has had the bad sentiment in recent years relating to the land tax thresholds. But if you run the numbers and if you own property across the board, you will find that the holding cost in Brisbane and Queensland is 3 to 4 times higher than in Melbourne. So it's all a load of bullshit when you hear all the stuff around land tax. Sure, you got to pay land tax, but the rates are a quarter of the cost than what you pay in Brisbane. With the recent floods and hurricanes and the upcoming Olympic Games, the local councils need to raise money from somewhere, so the rates are 4 times as much than in Melbourne. So the holding costs are lower in Melbourne, so don't be shy of land tax. No different to rates, land tax. So it's not holding the market back. I don't believe it has been the reason for holding the market back in recent years. I believe it's just where the market sits in terms of the overall macro cycle. Rents are rising, yields are becoming attractive, prices are already starting to run. It was easier buying real estate in Melbourne in 23, 24 than it has been over 2025. It's been slowly trending up, as you can see, and it's only a matter of time where the mainstream will catch on and every man and his dog will want a piece of it. So this is where I see each market sit based off the 18-year land cycle framework, based off long-term historical trends, and this is where I can see them heading into the future. We have the likes of Adelaide, South Australia, showing signs of hitting a market top within the next year or so. Will top out and go through a downturn, followed by Perth, regional WA in that final FOMO, fear of missing out. That's where all the stupid money's going. Give it another year or two, that'll also top out and then go through a more severe downturn. Brisbane, regional Queensland, probably has another 2 to 3 years to run, is also getting a lot of the final FOMO stupid money because of the Olympic Games. But the Olympic Games is not a reason to invest in the likes of Brisbane or regional Queensland at this stage of the cycle. When buying real estate, it's like baking a cake. You need to get into the market early, like Sydney, Melbourne today. Bake the cake in right from the start. Let the market do 90% of the heavy lifting, because it will do 90% of the heavy lifting. And then if there is an Olympic Games or there's new infrastructure, that's great. That's like the final icing sugar hit to the market. So sure, the Olympic Games is great with all the investment that's going in, with all the tourism that will come from it. But that is the final sugar hit, the final icing sprinkles on the cake. You needed to get into Brisbane 5, 6 years ago to enjoy that growth because the market has more than doubled in the last 5 years. So definitely not a time to get in. And ironically, the market will actually turn through a downturn based off long-term trends and what the 18-year land cycle suggests before the Olympic Games even comes around. So by the time they open the Olympic Games in 2032, Brisbane will be well and truly set through a severe downturn. So buyers beware. Same goes for Darwin. It's in its final couple of years of boom, but has also doubled in recent years. So never a good idea to buy into a market after it's doubled in recent years. You want to get into markets after 7, 8, 9, 10 years of stagnant flat growth, because that's any time where she will just hook. Like where Sydney, Melbourne are today, they're at bottom. There's only up from here. And it's early days for regional Victoria, New South Wales, Hobart, Tassie. You've got plenty of time. You can go buy a house out in those regions, but you'll be able to buy at the same price point, even at a lower price point in 3 to 5 years' time, especially once the market does turn into 2028. So that's a snapshot. Beware of all the spruikers pushing you into all these overheated, stupid markets. If they're not across this stuff, they're only going to get yourselves or their clients caught out when the market turns. As always, this is by no means financial advice. I'm not a financial advisor or financial planner. I'm a property investor and I help people do much of the same. And my whole philosophy around investing is using the 18-year land cycle framework to invest. It'll give you the best clarity, understanding that, yes, we are in the eve of a severe downturn. This one's going to be massive. This one is going to be like the 1990s recession we had to have. Jim Chalmers, he's going to stand up and he's going to be quoting his old mate Paul Keating saying this is the recession we had to have on steroids. You wait. It is going to be the downturn that is ingrained into millennials, just like the downturn of the early 90s was ingrained into the baby boomers. Buyers beware, don't get caught up in the fuss, don't get caught on the wrong side when the market turns. Not every market will be going backwards. Some markets will actually be booming. In the likes of Sydney, Melbourne, in the affordable stock levels, there's always demand and never enough supply of affordable housing. And in times of crisis, the bottom end rises as the demand shifts to the bottom end. Everyone needs a roof above their head. The RBA will be dropping rates to near zero, printing a shitload of money. They'll soak all into asset value. That feeds into the bottom end. Federal government will step in. They'll come up with some new first home buyer grant. That all feeds into the bottom end. So the bottom end rises in a time of crisis. Meanwhile, the top end of town's coming off, getting smashed. Commercial real estate would be getting hammered. New and off the plan would be getting hammered. All the regions like Darwin and Townsville and Brisbane and Perth will be getting smashed. And all the demand will be coming back to Sydney, Melbourne. Sydney, Melbourne will be leading again away at the races, just like what happened from 2008 and onwards. Hope that helps. If you need help, shoot us an email. Happy to jump on a call, discuss where you're at, discuss your plans moving forward and how we can help you get to that next level and keep building and growing your portfolio to be self-sufficient and sustainable for the years ahead. Until next time, thanks for watching.